Hello guys, thank you very much for joining in. We're going to be starting out with this quick revision of this chapter called banks. From the exam perspective, you can expect one question from this chapter. It's a theoretical chapter. We'll quickly walk you through the main concepts, and I will also highlight which concepts is important. Let us look at the first module. It talks about banks. Now in this module, they are primarily focusing on what are the different variations of bank. Okay, first they've talked about commercial bank. Commercial bank means which are into dealing with corporates, with into the retail section or the wholesale section. Retail means they are dealing with individuals or small businesses, and for example like auto loan, home loan, small working capital loans and all of that. There is a wholesale banking which caters to bigger clients or bigger customers, mostly institutional customers or corporates, where the requirement is very big, letter of credit. Then they are also opening up salary accounts for them. Okay, they're giving line of credit, they're giving working capital to them, they're giving long-term loans to them. So all of this is going to get covered in the wholesale banking. Apart from this commercial banking, you also have investment banks. Now investment bank primarily involved into underwriting and merger and acquisition and advising companies. Now, underwriting means whenever a company wants to issue debt or equity in the market, they need an expert who knows the rules and regulation, who knows the taxation related part, who knows how to do the valuation of these securities. That is where investment banks comes into picture. The second major role that they perform is advising. Within advising, there is merger and acquisition of the company. There can be advising with respect to restructuring of the companies also. All of this is basically provided as a part of the service. So banks are bifurcated into commercial banks and investment banks. Within commercial bank, you have retail and wholesale. What are the major risks that the banks face? This entire section is important. Make sure you're comfortable with this part. Credit risk, this is core to banking industry, because what simply bank is doing, suppose bank is sitting over here, bank is going to take money from people who are savers, okay, and they will give out loan to companies or individuals who are looking out for money, right? So bank is nothing but a broker in between managing the money. So if suppose tomorrow the companies or people who are looking out for loan, they are not in a position to pay back, that's a credit risk for the bank. Why? Because they still have to pay to the savers who had opened a fixed deposit, saving account, current account, whatever it may be. They have to still pay back. Okay, so that is first major reason. So whenever you are giving a loan and the borrower is not repaying or not following the terms and condition of the agreement, that is a credit risk. The credit risk is further bifurcated into the counterparty risk which the companies are facing with respect to derivative contracts. So these companies or these banks, they also enter into derivative contracts like swap, like options, or interest rate forwards and all of that. In that case, where if the counterparty is in loss and you are in profit, and the counterparty is not paying you, then in that case there is a credit risk for you. Okay, so counterparty is having a negative value, and for you it's a positive value, which means you are in profit and still you're not getting the money back. In that case, you're facing the credit risk. Okay, now the when you banks are trading in derivatives, they also face market related risk, because the value of the derivatives will go up and down based on the value of the underlying asset. In that case, they are also facing the market risk apart from the credit risk, which we'll be covering in more detail as we move ahead. When we talk about loans, okay, the interest rate that generally the banks charge, okay, that interest rate ideally should cover, okay, the cost of fund. Okay, that if you remove cost of fund, then you'll get the differential amount. So for example, if suppose the bank has raised money at 7% from the savers, and then the same money has been given as loan at 12%. The difference between that, the differential, is the actual money which the bank is earning, and on the basis of that, okay, you have to manage a lot of things. First, you have to manage your operating cost, because you have office, you have people, salary, everything you have to pay. Then you also have to take into account expected loss, because in the loan, on an average, you might face some loss, and that is the expected loss that you have to take into account. Suppose if the difference between the money that you have raised and the amount that you're charging on the loan is around 2%, out of that, first you're going to remove the expected loss, which is going to be 0.6%, and the remaining, which is 1.4%, this is the amount that is left with you to manage all your operating expenses and then finally make a profit. This is what the section primarily talks about.
Are you ready to ace the financial risk management exam? I know clearing FRM is tough, and to ease out your journey for preparing for the exam, our crash course will help you. Because in our crash course, we have a concise and crisp content covering the entire Swagger book, everything given in the book, and this crash course will give you the edge to pass the FRM exam. So don't miss out. Check out the link in the description.
Let us move to the next risk that the bank face: market risk. Now, banks has made investment into a lot of securities like bonds, stocks. If suppose due to market risk factors, the value of these securities are going down. Okay, suppose bank has undertaken a responsibility into foreign exchange, and the value of the currency is going against the bank. That is the risk that you're facing. Sorry. So bank basically, when they are using their own money to invest into market, that is where they start facing the market risk. In a lot of cases, banks are also allowing their customers to invest, okay, where they do not face any market risk. Why? Because bank is actually sitting in between and acting as a market maker. It is like this. So when you are standing in the bank is standing over here. In between, there is customer A, there is customer B. Okay. Customer A, suppose customer A has taken a long position, so bank has become a short position. For customer B, who's taken a short, bank has taken a long position. So bank has no exposure in this case because bank is sitting in between as a market maker, taking both long and short on the same security, same amount, same number of units. So they do not face any market risk. That is kind of zero for them in this situation. The next part is operational risk. Any organization which is running an operation, they faced an operational risk. That means that can be impact related to people, process, system, and external. Okay, all four can impact their operations. That means first, people who are not able to perform their duties properly, they made some mistake, they made some fraud, and because of which your operation is getting impacted. Process, your internal controls were not proper, and because of which a lot of people were misusing. The process was not defined properly, and because of which the company is facing a loss. Next is system. Your IT system is not working. There is a failure. Your servers are not working. Because of all of these impact, you are facing an issue. Okay, so all of these things can lead to an impact. What is external event? Suppose there is a flood, there is earthquake, and because of which these external events, there is a damage to your assets or your business is not able to perform properly. All of these things can lead to a impact in your operations. Okay, let us move to the next section, which is economic capital and your regulatory capital. Now generally, why do we need capital? Because banks have to are taking a lot of risk on their books. So when they're giving loans or when they're trading assets, they're taking a lot of risk. To cover that risk, they need good amount of capital in hand. So generally banks have equity capital which will protect them to maintain solvency, which basically means which will protect them to cover any unrealistic loss that are there they're going to face in the future. Also, a lot of banks, apart from equity, they also take long-term debt to bolster their capital. That means to increase their capital. A lot of these debts are subordinate to the claims of the depositor. What this line is important. Why? Because this line primarily tells you that if tomorrow the banks default, banks are not in a position to pay back. The first money that they have to pay to is to the depositors, and then the debt holders will be paid. Then the bond holders will be paid if there is a financial distress. Now, equity capital is generally called as going concern capital, which is going to stay with the bank for a lot period of time. Debt is concern called as gone concern capital. This is generally raised to cover certain losses or certain specific operation related impact. Over here, they've just taken names for equity and debt. Next is banks and their regulators. Everybody is thinking that how much capital we should keep to protect ourselves. Now, there are two variations of the capital. First is regulatory capital, second is economic capital. Both the understandings are important for the exam perspective. Okay. Regulatory capital, the Basel requirement, the regulator has created a guidelines on the basis of which you are supposed to keep certain money. Okay, that is your regulatory capital. Economic capital, banks are using their own models, own approach to understand what is the actual risk that the bank is facing. And on the basis of that, they are trying to identify what is the unexpected loss that we might face. And we try to find the capital. That is nothing but economic capital. So generally what happens is both regulator and economic capital, they talk about how much money that is needed to cover the unexpected loss which the business might face. Okay, if the business is able to keep that much amount of money, they will remain solvent. This is where we complete the second part of the chapter. Third part, Basel Committee and Regulation. So banking industry, after 2007 and 8 crisis, the Basel regulation has been taken very seriously. Okay, so Basel Committee came out with this global regulation, okay, first initially they came out with the credit risk, which was basically the risk that the banks are facing with respect to loans and also with respect to the derivative contract. That was the initial understanding. Now, what has happened? Over time, they have realized that it's not only the creditors that they are facing, that the banks are facing impact. There is market risk and there is operation risk also. Hence, they also included them as we move towards Basel 3 and Basel 2 requirement. Let us move forward. So models which are used to compute regulatory capital, they are primarily based on standardized model which are coming from the Basel rules. But after 2007 and 8 crisis, okay, they realized that a lot of these banks were also using internal models. Now the problem with these internal model is that you cannot compare. As a regulator, I cannot compare one bank to the another bank. So what is happening? After this 2007 and 8 crisis, Basel Committee started asking all of these banks that you have to start using standardized model which is standard for everybody. If you're going to use any internal model, then it has to be approved by your national regulator. For India, it is RBI. Okay, and in that case also they have certain requirement, and this requirement is important from the exam perspective. What simply they are saying, suppose there is a standardized approach and there is an internal approach. If you got the answer with suppose the capital that they are looking out for, okay, so the capital requirement under both of them has to be calculated, but okay, if you're using an internal model, it cannot be lower than 72.5% of the standardized model, which means suppose you use the standardized model and you got a capital requirement of around $100. Okay, and internal model, suppose you got a capital requirement of around 35. This is very low because you are creating your own model, so you have more control on the model. Okay, so what banks regulators saying, no, you cannot keep 35. Whatever is the standardized model answer, if you're using internal, it has to be at least 72.5%. So you cannot keep 35, you will have to keep at least $72.5 for the internal model approach. So basically they are creating a floor. That is what the important part is, and this is going to be applicable in the future. After Basel 3 also they came out with a very specific requirement which talks about liquidity. Now this is important uh, from the level 2 perspective. For level 1 they've just given you an introduction. Liquidity coverage ratio, which basically means whether the bank has sufficient amount of high quality asset to cover the 30 days of stressful period. That means cash outflow. So they should have good amount of quality assets to cover those 30 days of high impact situation period where there is going to be a lot of cash outflow from the bank. Similarly, net stable funding ratio is also introduced. So whatever liability that you have, do we have stable assets available to cover those liability or not? Because a lot of these banks, they do maturity mismatch between their asset and liability. So they raise money for a short period of time, that means liability, and they invest into long period of assets, which creates a maturity mismatch. Okay, let us move forward towards the deposit insurance and the moral hazard. Why do we need deposit insurance? Because the depositors, they need some kind of satisfaction or some kind of guarantee that if tomorrow there is a default of the bank or there is a financial distress of the bank, we will get some amount of money back. That is where deposit insurance comes into picture. In the US market, it is around $250,000. In India, it is 5 lakh rupees. A depositor's fund is guaranteed up to some maximum amount, like in India, 5 lakh rupees. This is guaranteed by a institution, which is a government institution. Now, why do we do it? Because we want to make sure that the depositors feel safe to put their money into bank. Now, what banks are also doing, because they want to make sure that deposit insurance is there, the banks will start paying premium to these insurance companies who are giving the insurance guarantee. Okay, so banks will have to pay the premium. Now there is an impact of moral hazard. How? This is on both the sides, from the bank side, from the customer side also. Okay, so first, what is moral hazard? Suppose if I have taken insurance, my behavior changes after taking insurance. Okay, a very good example of this would be after taking life insurance, I'm doing scuba diving, skydiving, which I would normally not do. So in a banking context, when a deposit insurance is there, moral hazard is there. Why? Because depositors now, because they know there is a deposit insurance, they will not pay much attention to the health of the bank. Okay. From the bank's perspective, also what they are thinking, because we have already taken insurance, now if tomorrow anything happens to me, the bank insurance company will pay to my depositors. So I'm not worried. I'll start giving high risky loans which can give me high returns. So and because of this, a lot of the banks failures happened during 1980s and between 1980s to 2000 in US market, even though they had a deposit insurance, because there is a moral hazard. How do we tackle this? This is important. Okay, how do we tackle it? First and very important change that can happen is the premium, which is risk based. That means if there is a bank which is well capitalized, that means they have good amount of capital kept, the premium will be lower. If it is poorly capitalized, the premium is going to be
higher. Are you ready to ace the financial risk management exam? I know clearing FRM is tough, and to ease out your journey for preparing for the exam, our crash course will help you. Because in our crash course, we have a concise and crisp content covering the entire Swagger book, everything given in the book, and this crash course will give you the edge to pass the FRM exam. So don't miss out. Check out the link in the description.
Let us go to the next section. This is more pertaining to the activity which the banks are expected to do. Investment banking financing arrangement. Let us look at this section. The first part, okay, investment bankers basically help companies to raise money through issuance of stocks, issuance to bonds. Okay, generally they sell this to a particular buyer or a group of buyers. Now they can do it either through private placement. Private placement means Reliance is directly selling it to Facebook. Okay, this is only sold to qualified investors. So regulators decide who is a qualified investor and who can participate. Generally, qualified investors are those people who have good amount of knowledge and substantial wealth in that domain. Okay, retail investors are not allowed and not qualified investors. Okay, what investment banks generally do, if they help a company to raise money, for example, if I help Reliance to raise money through Facebook by selling shares, I will be making some fees for arranging this entire deal. Okay, there can also be public offer. It simply means that I am not going to any particular group of people or any particular person. I'm directly going to public at large. That is why it is called as public offering. So generally you see IPO, initial public offering, or the public offering of the bond. That is where the investment bankers comes into picture, because you are selling the security to a public at large. Now over here, investment bankers can participate into two ways. Both of them are important. Okay, firm commitment and best effort. What is firm commitment? Basically, they are saying that, okay, I will purchase the entire shares that you're going to, that you want to sell. I'll purchase everything. Okay, and I will give you guaranteed this much amount of price. And after some time, I will sell your shares to general public. Okay, this is where the commitment is given by the investment banks, and investment banks will take this opportunity only, okay, if they are confident on the company. If they are not confident, they will enter into best effort. What is best effort? It simply means it's primarily less risky for the bank. Why? Because I will help you to raise money. If the market is good, you will be able to raise money. Okay, your IPO will get more subscribed. Okay, but if it is not good, you will get undersubscribed and you will only be able to raise a small portion of it. I will, as an investment bank, I will earn a fee income for the service which I'm providing. Over here, I'm not giving any commitment to you. Both of these things are very important from the exam perspective. Mark this as star. Next is initial public offer, same repeated. So when you publicly go and sell your securities or shares, the IPO is, that is called as IPO, where an issuing firm is selling their share directly to the public. Now, investment bankers can help you determine what should be the IPO price, okay, and what should be the process of doing the IPO. Generally, one of the very famous processes is Dutch auction process, okay, wherein generally what happens, any company, for example, DMart, if they want to raise money, okay, they will give a price range. Suppose that price range is say 100 to 150. Now bidders will start posting, okay, that we want around, suppose there are 100 shares which DMart wants to issue. Okay, there was customer number A, okay, who is saying that, okay, I want to buy 30 shares, but the price that I'm quoting is around 145. Then there is customer B who's saying that, okay, I want to buy say 50 shares, but the price that I'm quoting is around 140. Okay, then there is customer C who's saying that, okay, I want to buy 40 shares, but the price that I'm quoting is 142. So you will suppose, let us assume there are three such bidders. You'll always start with the highest. Okay, so in this case, who is the highest bidder? The highest bidder is A. He has quoted 145 and he's asking for 30. So out of 100, I'll give 30 to him. I'll allocate 30 to him. Okay, the next, who is the next highest? C. He's saying I'll be buying at 142. How much? 40. So the rest, next 40 is allocated to them. So now out of 100, 70 is gone. Only 30 is left. So B, who has quoted 140, okay, he'll only get 30. He'll not get 50 shares because there are only 30 shares remaining. Now, in a Dutch auction process, everybody will pay the last price, which means 140. This is going to be the issue price. because this is the lowest price at which the security is being sold. So everybody will start paying at the same least price. Okay, this is the price which is paid by all successful bidder. So first customer number A, he will be getting 30 shares, but he'll be paying 140 rupees. C, he's going to get 40 shares, but he'll be paying 140 rupees. And B, he'll be getting the remaining 30, he'll be paying 140. So 140 is the issue price. Okay, so this is how the entire Dutch auction process actually works. It is basically the equilibrium between the supply and the demand for that particular security. Next, an important section over here, potential conflict of interest. Now, in the US market, there are restrictions with respect to, as a company, can you hold a commercial banking license, investment banking license, or securities license altogether? Because there is a huge amount of conflict of interest. Let us look at the first example. Look at this example, the first one. Suppose you are working in investment banking domain and you have got a mandate to do an underwriting for IPO of DMart, okay, where you're going to be issuing some new stocks or say bonds of that particular company. Now, if suppose I want to sell this because I've given firm commitment to DMart and I want to sell this security to people in the market, what I can do is I can call up my securities division, okay, which is basically a broking part of the business, and I can tell them that push this DMart shares to your particular customer. Okay, so I can ask them to sell this share to the customer. Over here, the what securities business will do, they will issue a strong buy recommendation to DMart, and they will put pressure on their customers, they'll put pressure on their analysts to talk good thing about the company. Okay, so there is a conflict of interest. What is the conflict of interest over here? See, when I'm doing this entire activity, why my securities business is being so aggressive in selling DMart? Because my investment banking business is associated with it and they will be making money. So over here, I'm losing the duty towards the client. It is very simple because I'm not thinking about the client when I'm starting to selling the security. This is the first example. Look at the second example over here. Another clear conflict of interest is among the banking department. Suppose if I am a Yes Bank and I have there is some company ITC which is coming to me for banking license or banking related loans. Okay, when they're applying for loan, they will give me a lot of non-public information about the company with respect to the sales which is happening in the current year, some new orders which they are going to get, so that they can better negotiate the loan. Okay, so now over here, suppose the commercial banking division, they pass on this information that okay, this ITC company is going to get some government order, and they pass on this information to their trading desk. The trading desk will, based on this information, can take position, and because of which they will have an undue advantage. Over here also there is a clear cut conflict of interest that the material non-public information is passed on to the particular division. Next part. Uh, so because of these inherent conflict of interest, a lot of US states, what they are explicitly saying, that you cannot hold all the three businesses together in particular state. Okay, and that has become in the Glass-Steagall Act. And also they have been asked to keep Chinese wall. These walls are not physical walls, but a barrier to the information. Suppose there is a team which is holding a material non-public information, there should be some barrier through which that information should not pass on to everybody else. That concept is called as Chinese wall. These are internal controls which banks will have to keep. The next part, banking book versus trading book. Okay, now over here the banking book explicitly talks about that those assets which I've created, which are going to stay with the bank for a longer period of time. Okay, which means I'm going to hold it till the maturity. One of the very easy example of this would be the loan. When I'm generally bank gives loan, they are going to hold that asset, hold that loan till the end. Okay, in their books. So all the credit risk, market risk, whatever risk that they are facing with respect to that loan or asset, that they're going to hold till the end. Okay, generally the capital requirement is slightly higher for the banking book because they're going to stay for a longer period of time. When we talk about trading book, it is basically for those securities which are connected to my trading activity. I'm going to buy, but I'm going to sell it in few days. So because I'm going to only hold it for a very short period of time, the risk is also very low. Okay, next part is that these securities are mark to market. Why? Because they're actively traded in the market. So every single day I can do the valuation of that security and try to see what is the overall size of my trading book. Okay, now the interesting part, when I'm calculating capital, the capital requirement is slightly lower for the trading book as compared to the banking book. Generally, before 2007 and 8, what a lot of these banks were doing, even though the asset okay, was a banking book asset. I was keeping it in the trading book because I wanted to give lower capital requirement part. So my less money is getting stuck, and this is more return on investment for me. Okay, but now what has happened? The regulators have come out with FRTB, Fundamental Review of the Trading Book. That means you can only put a particular asset into the trading book if you have a dedicated trading activity for that particular asset. If you are putting it, you cannot change it again. Suppose if you have already put an asset in the banking book, you cannot move it to the trading book till the time you have a very strong reason. That is what the rules that they have brought in. This is going to come in your level 2. Let us move to the next part, originate to distribute. This is nothing but securitization. Now, originate to distribute model means what? Suppose there is Yes Bank. Okay, it is giving a home loan to Mr. A. Now, previously, if it is originate to hold, OTH, then the loan will be on the Yes Bank book only. But suppose if I'm doing originate to distribute, I'm simply doing what? As a Yes Bank company, I'm packaging all of these loans, similar kind of loans. Okay, suppose 1,000 home loans, and I'm creating a pool of these 1,000 home loans, and on this pool, I'm going to sell a new security. Generally, this security could be MBS. It can be CDO, CLO, all of these. Okay, so now whoever is buying this MBS is basically owning this pool. Okay, for Yes Bank, what they're simply doing, they're creating the pool and they're selling it to somebody else. So they are not worried what is the kind of loan that Mr. A has taken as a home loan. So over here, the underwriting standard also goes down. Okay, now, so what is this origin to distribute model? It is basically making loans, selling them to another party. Okay, now in this entire OTD model, okay, there were government agencies like Guinea Mac, Fannie Mac, and Freddie Mae. All of these government agencies were helping them to create the securitized product. Now, what is the benefit of this OTT model? Okay, again, this entire section is repeat in mortgage and mortgage-backed security chapter of this book. Okay, what is this OTT model going to help you? It brings liquidity in the market. Okay, now why? How come liquidity? See, when Yes Bank is creating a pool and selling it, they are getting their money back. Now they can issue more residential loans. Okay, that is the first part. So you have more capital which is free. Okay, and because of which you can sell more loan. So for the bank that originated the loan, okay, I'm selling the current loan to the other party. All the risky loans are going out of my book, so my capital requirement is also going to be low, and I'm getting the cash back which can be used to issue new loans. Very simple, the first part. Second, look at this, increase liquidity. Now, because what is happening, it's not only about home loans. I can take student loans, credit card loans, commercial bank, all of these not so liquid assets. Because of securitization, now it is getting liquid and now it is being sold to somebody else. So for the bank, it is very, very good information, a very, very good step. What is the drawback? So what effectively started happening in 2007 and 8 crisis also is that a lot of these banks, they realize that the loan that I'm going to issue is not going to stay on my book. I'm going to just sell it off to somebody else through OTD model. So let us start reducing the lending standard. That means let us start giving loans to anybody with no job, no income. I started giving loans. So lending standard reduced, and this was one of the bigger factor which led to this 2007 and 8 crisis. So from the exam perspective, I have highlighted important part that is important for the section. Thank you very much, guys, for joining in.